Picture the scene. Bitcoin, the world's first and most famous cryptocurrency, plunges below $108,000, wiping out billions of dollars in market value within hours. Headlines flash warnings of doom and panic grips the retail crowd. Yet, behind the scenes, the world's largest institutional investors are not running for the exits. Instead, they are quietly increasing their stakes, accumulating Bitcoin at a record pace. What do these financial titans see that most of us don't? Are they betting on another legendary comeback? Or are they simply setting themselves up for disaster? Let's pull back the curtain on the forces shaping Bitcoin's fate and uncover what could be next for the world's most volatile asset. To understand today's drama, we need to rewind the story. Bitcoin is far more than a speculative digital token. It is an economic revolution that has challenged traditional finance, upended technology norms, and even forced central banks to rethink their playbooks. Every major move in Bitcoin's price reflects a complex dance between global events, policy decisions, and technological shifts. Consider inflation. Each time consumer prices in the United States rise, as measured by the Consumer Price Index, or CPI, Bitcoin reacts with lightning speed. In the most recent report, inflation for the United States ticked up to 2.4% year over year, with a modest 0.1% increase for the month of May. This seemingly minor uptick sent shockwaves through financial markets. Stocks wobbled, bond yields shifted, and Bitcoin, ever the volatile asset, slipped below $108,000, shattering a psychological support level that many traders considered unbreakable. But here's the twist. Instead of triggering a mass sell-off, this drop fueled a new wave of accumulation. According to data from Glassnode, exchange positions have seen consistent outflows all month, a strong signal that investors are pulling their Bitcoin off trading platforms and into long-term storage. Nearly 97.4% of all circulating Bitcoin is now sitting in profit, meaning most holders have an unrealized gain on their investment. This level of profitability is historically rare and often marks the early stages of major bull runs. Look at the whales, those deep-pocketed investors whose moves can sway the entire market. MicroStrategy, the publicly traded business intelligence firm, now holds over 214,000 Bitcoins on its balance sheet. Even after a wild sell-off in May, which saw whales dump over $2 billion worth of Bitcoin in a matter of days, the overall sentiment among these major players remains shockingly optimistic. In fact, the Bitcoin Fear and Greed Index, a popular gauge of market mood, currently reads 70, squarely in greed territory. This is a clear sign that big money believes brighter days are ahead. Let's dig deeper into what the experts are saying. Matt Hougan, Chief Investment Officer at Bitwise, predicts that Bitcoin could surge to $200,000 by the end of the next year. He cites a looming supply shock driven by surging institutional adoption through Bitcoin ETFs. Tom Lee, a respected analyst at Fundstrat, expects prices to reach between $120,000 and $125,000 by June. Meanwhile, ARK Invest, led by the famously bullish Cathie Wood, has set an eye-popping target of $2.4 million per Bitcoin by the end of the decade. These forecasts are not just pulled from thin air, they are backed by technical analysis and on-chain metrics. For example, Bitcoin is currently trading well above its key moving averages, the 111-day, 200-day, and 365-day markers, which have historically acted as reliable indicators of long-term momentum. But there's more at play here than just technicals and optimism. Bitcoin's price is now closely intertwined with Wall Street, thanks to the explosive growth of exchange-traded funds, or ETFs. BlackRock's IBIT ETF alone has attracted more than $45 billion in inflows, making it one of the fastest-growing ETFs in financial history. This institutional stamp of approval has brought Bitcoin into the mainstream and given traditional investors a new way to access crypto without the headaches of wallets and private keys. Yet, this connection is a double-edged sword. The 30-day correlation between Bitcoin and the S&P 500 has frequently exceeded 70% in the past 5 years. That means when stocks fall, Bitcoin is increasingly likely to follow suit. Imagine a scenario where a sharp downturn in the equities market triggers a wave of redemptions from Bitcoin ETFs, amplifying volatility across the entire sector. The next catalyst? All eyes are now on the upcoming Consumer Price Index release, scheduled for the 11th of June, 2025, at 8:30 in the morning Eastern Time. If the data surprises to the upside, meaning inflation comes in hotter than expected, Bitcoin could face renewed selling pressure as investors brace for higher interest rates and tighter monetary policy. Conversely, a softer inflation print could spark a rapid rebound as traders rush back in to front-run the next leg up. Meanwhile, social media platforms are awash with bullish commentary. According to Sentiment, Bitcoin's bullish sentiment on Twitter and Reddit has reached a 7-month high, reflecting a groundswell of positive public opinion. Funding rates across major exchanges remain low, indicating that the latest rally is being driven by spot buyers rather than leveraged traders. This organic demand is often seen as a healthier foundation for sustained price appreciation. Let's step back and look at the bigger picture. Bitcoin's resilience has been tested time and again by regulatory crackdowns, exchange hacks, and global financial crises. Each time, the network has bounced back stronger than before. Take, for instance, the China ban in 2021, which forced miners to relocate overnight. Many predicted the end of Bitcoin, but within months the network's hash rate recovered and prices surged to new all-time highs. Or consider the COVID-driven market crash in March 2020, when Bitcoin briefly dipped below $4,000, only to roar back above $60,000 over the next year. Yet even as Bitcoin weathers these storms, new risks are always lurking. Regulatory uncertainty remains a perennial threat. Governments around the world are grappling with how to oversee digital assets, and sudden policy changes can have massive repercussions. For example, if U.S. regulators decide to impose stricter rules on crypto trading or custodianship, it could dampen institutional enthusiasm and trigger a wave of selling. Standard Chartered recently warned that if Bitcoin falls below $90,000, corporate treasuries holding Bitcoin on their balance sheets could face significant losses, potentially leading to a domino effect across the financial sector. There's also the ever-present possibility of global macroeconomic shocks. Should inflation unexpectedly surge or geopolitical tensions escalate, Bitcoin's status as a safe haven asset will be put to the test. Some analysts argue that in times of crisis, Bitcoin behaves more like a speculative tech stock than digital gold, dropping alongside riskier assets. Others believe that as more investors view Bitcoin as a hedge against monetary debasement, its correlation with traditional markets will eventually weaken. So what does all this mean for you, the viewer? Whether you're a seasoned crypto trader or simply crypto curious, understanding these dynamics is crucial. The key takeaway: don't get swept up in the hype or succumb to panic. Instead, ground your decisions in data and analysis. Keep an eye on technical indicators such as moving averages and the relative strength index to gauge trend strength. Monitor the flow of funds into and out of Bitcoin ETFs, as these shifts often precede major price moves. And, perhaps most importantly, pay close attention to macroeconomic indicators like the Consumer Price Index, as well as central bank announcements and regulatory developments. If you're considering an investment, remember that Bitcoin's volatility is both a curse and a blessing. While nearly 97% of current supply is in profit, history shows that dramatic swings, both up and down, are part of the journey. Experts like Joe Burnett from Unchained emphasize that Bitcoin's monetary superiority over gold, thanks to its fixed supply and predictable issuance schedule, is both its greatest strength and its most scrutinized feature. Unlike gold, which has been mined for thousands of years and still sees new discoveries each year, Bitcoin's total supply will never exceed 21 million coins. This hard cap, combined with a current inflation rate of just 0.83%, lower than gold's annual rate, creates a powerful tailwind for long-term value appreciation. Let's explore what the future might hold, stretching from the most optimistic scenarios to the potential pitfalls ahead. If current bullish momentum persists and institutional demand continues to rise, we could witness a historic surge. Bitwise analysts estimate that Bitcoin's fair value could reach $230,000 by the end of next year, driven by continued ETF inflows and growing acceptance among corporate treasuries. ARK Invest's boldest projections envision Bitcoin soaring to $2.4 million by the year 2030, as digital assets become a core component of global portfolios. Recent data supports this narrative. Inflows into spot Bitcoin ETFs have exceeded $2.8 billion in just the past few months, underscoring the depth of institutional appetite. BlackRock's IBT ETF, with over $45 billion in assets, has become one of the top-traded funds on Wall Street. Even more telling, the low funding rates across major exchanges suggest that this buying is not driven by leveraged speculation, but by organic demand from long-term investors. As Bloomberg's Eric Balchunas puts it, this classic feeding frenzy shows no signs of cooling. However, the road ahead is not without hazards. Should inflation spike unexpectedly or regulators adopt a more hostile stance, Bitcoin could suffer a sharp correction. A sustained break below key support levels, such as the $106,000 mark, would invalidate many bullish forecasts and could trigger panic selling. History teaches us that coordinated crackdowns or unforeseen events, like major cyber attacks, can ignite brutal market crashes. Standard Chartered's warning about the risks to corporate treasuries if Bitcoin dips below $90,000 is a stark reminder that even the biggest players are not immune to downside risk. For everyday investors, this environment calls for careful strategy. Consider adopting approaches like dollar-cost averaging, which involves buying a fixed amount of Bitcoin at regular intervals, regardless of price. This technique helps smooth out volatility and reduces the risk of buying at a market top. Stay diversified, don't put all your eggs in one basket, and always use proper risk management tools. It is also essential to maintain a long-term perspective. While short-term price swings can be nerve-wracking, Bitcoin's resilience over the past decade has continually surprised skeptics and rewarded those with patience and conviction. As Noel Acheson, a leading macro analyst, notes, it's this dual narrative nature that gives Bitcoin a higher floor. Bitcoin is both a risk-on asset that attracts speculative capital during bull runs and a potential safe haven during periods of monetary instability. Let's not forget the technological side. Bitcoin's underlying blockchain has proven remarkably robust, withstanding attacks, forks, and existential threats. The mining network, which secures the blockchain, is now more decentralized and energy efficient than ever. Innovations in self-custody, privacy, and Layer 2 scaling solutions are making Bitcoin more accessible and user-friendly. These advancements could help Bitcoin solidify its role as digital gold for the information age. Looking further ahead, several scenarios could play out. If regulatory frameworks become more favorable and major economies embrace digital assets, Bitcoin could become a staple of pension funds, endowments, and sovereign wealth portfolios. This would drive trillions of dollars in capital into the ecosystem, pushing prices to unimaginable heights. Alternatively, if governments clamp down or a major black swan event occurs, Bitcoin could face renewed volatility and even a prolonged bear market. The future hinges on how well Bitcoin adapts to these shifting winds. So, will Bitcoin rebound to new highs or plunge into a deeper crash? The answer will depend on how these powerful forces, macroeconomics, regulation, and institutional demand, interact in the coming months and years. One thing is certain, Bitcoin's resilience, tested over and over, has continually rewritten the rules of finance and surprised even its most ardent critics. If you want to stay ahead of the next big move, make sure to subscribe and hit the bell icon. We'll be following every CPI release, every ETF milestone, and every regulatory shockwave, so you're never caught off guard. Where do you think Bitcoin will stand after the next inflation data? Share your thoughts in the comments below and join us